So welcome to the Forex Weekly this week. I'm Mike Swanson with TradeWest Forex. We're going to be talking about how does market depth work. And so this is something that's going to kind of be a continuation from last week. So last week we taught about what causes the price to move. And I thought, market depth kind of goes along with that, and it'd be important to understand a little bit about that. So let's take a look at what is market depth. Okay, market depth is, here's the actual definition. It's an electronic list of buy and sell orders organized by the price level and updated to reflect real-time market activity. So what that means is you're basically seeing where everybody's orders are at, where they're actually publishing where they want to get in and out at, above the market and below the market. So we have a tool on our platform Informer that shows this, called Market Sentiment, but I'm going to be showing you actually Market Depth, which is a little bit different tool today. And it's also, some brokers refer to it as level 2 quotes or level 2 information, where they'll be transparent and kind of tell you where their order books, where the orders are at in their books. And what this does is it actually gives you an idea of how much liquidity is available on both sides of the market. And so you can see if the market's thin, if you're going to have slippage problems trying to trade, and it especially helps those that are, starting to trade larger lot sizes to get an idea of how much they can get in at the current price. But it's good to understand how all this stuff works. Just like last week's lesson, we had a lot of great comments come out of that, and it really helps to just know what's really going on, and to cause these prices to move and how the spread is formed and all that. So how does this work? How does the market depth work? Well, some brokers actually allow traders to offer liquidity through bid and offer orders. So bids and offers are a little bit different than you taking a market order and trading at the bid or offer. Okay, so I'll explain how these work here in a minute when we go onto the platform and show you how this stuff works. But basically, it allows a trader to enter or exit without paying the spread. Okay, so that's their goal of putting in bids and offers and offering liquidity, is they're trying to get the best price, either, like I say, to get in or to get out. And the risk that they take is the market can move without them. It's not like a market order where they're in. They only get filled if somebody takes the price that they're offering. Okay, what can happen is somebody else can come in and provide a better price, and then the market can just move away and they miss their opportunity. But it's a risk they're willing to take in certain situations. There's lots of strategies involved with this stuff. So next question I'm sure you're wondering is, where can I see market depth? Okay, well actually soon our Informer platform will have this feature. We're looking to actually provide that so everything will just again be in one place. That's been our goal with our platform, is to try and tie everything in. And we're actually getting charting added right now, so that should be available soon, and then the market depth too. So, but for now, there are a couple different brokers out there that provide it, and the one that I've liked the most, that I've used in the past, is the Dukascopy JForex platform, and you can get that at Dukascopy.com, and you just sign up for a demo account on their website. And what you have to do actually is, if you're in the US, they partnered up with FXDD, so it makes it so you download a different platform, and that's not what we want. So what we do is I just put in a different country. It doesn't really matter. We're just using it for a demo, just to get on and use and see the market depth. So you can do it that way, and that way you'll get the right platform and everything. So I've went and downloaded this so we can go over it and kind of show you where to see the market depth, where it's at, how it works. So let me grab that really quick and bring that up, and then we'll go over it together. If we just go over to Dukascopy.com, I'll bring up this page for you here. Okay, if you just go to Dukascopy.com, there's a little red link on the left side here that says Open Demo Account. Okay, you just click that, And like I say, when you fill these fields out, it doesn't really matter what you select for balance or most of the stuff. You just want to get logged in. So and like I say, for country, I know in the past if I've chose United States, it will, because they don't accept you to open a live account. They make you download a different platform. Yeah, you see, so it says you make sure you open it with FXDD. So we really don't want to do that. We just want to go back in here, open demo, and we can just put something else there, fill out the form, accept it, get your demo account, and then it's going to take you to the platform download page, and it's going to email you a login and password. So that page will look like this, and then you just download, you click here on the J4X platform, right here where it says demo start, and then log into it. And once you've done that, I'll show you my platform it brings up here. Okay, it brings up this platform with some default charts. The only thing we're really going to be paying attention here, at least for this lesson today, is this little box right here that says market depth. Okay, so you can see it's right here, and there's a couple of things we need to explain on this so you know how this all works. First thing is these set of numbers up top. Okay, those numbers are simply adding up all the values you see in the market depth. They're adding up all the volume, and they're adding up all the prices and giving you the average. So they're telling you there's 194.7 lots. Okay, that's that's million. That's 194 million in currency. Okay, and so that's basically every million in currency is 10 standard lots, right? Because a standard lot's 100,000. 10 lots is a million. So this is 194 million or 177. You see it changing. That is actually 1,700 lots right there. You just have to move it over a decimal. 1,776 lots you can get in at 101.35, which is about a pip and a half below the price. So you can clearly see there's a ton of liquidity right now in the US yen through Dukascopy's providers that they have. Now every broker will be different depending on what liquidity sources they have, just like we talked about last week. That's why some spreads are different than others, and this helps kind of tie that all together, right? You can now see exactly why the spread, I mean, we're seeing a really tight spread here. Of course, this is just a demo, but you get the idea. It's because there's somebody right here, okay, that first slot is the next best available price on the bid side. So there's 1 million, which is 10 lots at this price that you can sell right now, and the same number shows right up here. Okay, and then for the buy side, this is the best available price at the ask, and here's the volume at that level. And you can see orders are constantly being added and subtracted and taken from the market, and when that happens, it moves to the next level. So that's, like I say, that some traders could come in here and offer a better price inside the spread, and that's what causes prices to move, like we talked about last week. You might just want to go review the lesson from last week after this one today. So let me show you a quick little demonstration of how you can actually put bids and offers in on some of these platforms like this, and how you can actually manipulate the price. Since this is a demo, it's actually going to let me do this fairly easily. So what I can do here is I can go in. I'm going to select a pair that has a little bit wider spread, so it's more obvious of what I'm going to do here. So let's see. Let's grab something like just an exotic currency pair, something not very popular. Even that one's got a tight spread. Let's see. Let's try. Okay, that one's good. So we got about a 6 pip spread here, and what I'm going to show you is if you place a bid instead of taking the bid, you can actually trade inside the spread and buy at a much lower price than 21. That's their idea of somebody wanting to place a bid or an offer. Or they can kind of manipulate where the market might go. There's a lot of different things they can do with this. But my main goal today is just to show you kind of how it works. So if I hit place bid, I can say it looks like it's showing it in units. So let's bump that up so it can actually show it on here. If I go 100,000, it's going to show 0.1 at whatever price I put. If it's within the spread, I'm going to see it up here. If it's outside, I'll see it down in the depth. So let's put it at 16.5. you're going to actually see the price move. I'm going to move the bid up to 16.5, and it's going to have a 0.1 there because I'm going to become the next best available price. So watch how this works. Okay, there you go. I'm 16.5 at 0.1. And you'll see down here, that's actually saying I'm going to put a buy trade in at that price. Do you see that down here? It's saying I'm going to buy at 16.5, not 19.8 where it's currently trading. I'm the bid right here, the 0.1, 100,000 francs at 0.1. If somebody hits the market order on that, I will get filled as a buy trader. They will get filled on their sell order. So does that help make sense? That's kind of what we talked about last week, but now I thought it'd be good to have a nice visual of exactly how this works in real time, in the markets. This is exactly what's causing prices to move. And what could happen here, say nobody wants to take my order, look what it does. The market's moving up now. Now the bid, the ask is sitting there at 20, so I can move this order again. I could come in here and edit order. I could say, okay, I no longer want to go there. I see the market's moving up. I could go up, bump it up to 19.5, and there you go. I jump the price up. And if the market still has no demand to go short, what's it going to do? Traders are going to take the offer, they're going to take the ask side, and actually move the price up, and my order still won't get filled. So you see, that's the risk, like I say, of a trader that trades this way. He might be able to skip the spread, but he doesn't mean he gets filled. Somebody has to take that. Otherwise, it just keeps moving up without him, and you miss your trade. Okay, but I'm not trying to teach you a strategy here, really, of how to do this, how to go trade inside the spread. It's not as easy as it might look. It looks like a great idea. I think a lot of you are thinking, hey, I'd love to skip the spread, but there's a lot of things that go into this if you were trying to build a strategy out of it. But my main goal, like I say, is just to show you how it works. Now watch this. If I actually delete this order, what's going to happen is the price is going to move down to the next available price in the market, which is right there, 13.4. Okay, so watch this. I will right-click on here, cancel order, and there you go. It instantly moved the bid all the way down to 13.3. So if you came to last week's lesson or you watched the recording, I talked about how the spread is created, how the prices move. This should make it very clear now why the spreads will widen at news times or why the spreads widen in general. It's simply because somebody like me right there said I no longer want to offer a price that close, and I delete it, and okay, the market says that's fine, let's find the next available price. And that might be 5 or 10 pips away, and that can widen the spread like it just did here. Okay, and I can do the same thing on the ask side. I can hit place offer, okay, and I can put an offer. I want to sell at a certain level, and somebody takes my other side and buys at the ask. I can say, okay, I'll place an offer down at 38.18. Okay. And now you're going to see if I hit OK on that, I become the next available price to buy at. I've got 0.1 at 18. I will get put in at a sell. Instead of selling at 13.4, I would sell at 18. Okay, so all this stuff is it's called it's really called providing liquidity to the market. It's what happens constantly, thousands of times a day. And this platform actually has what they call centralized liquidity, which means they allow their traders to do this. So you can be taking someone else's, another one of their customers' other side of their trades. So anyways, that's how this stuff works. Hopefully it all made sense and it didn't get too complicated. Let's get ready to do some Q&A, and then we'll wrap this up here. Okay, so I'm sure you guys have some questions on this. It's something not a lot of people teach or really get into because a lot of people just don't know how it works. The way I learned about this is I was forced to learn because I was trading a lot of money when I would manage accounts. I had to learn how to get big orders filled without the market taking off without me or without the big slippage. So, well, like I say, let's do some Q&A now, and and also show you where you can get the recordings from today's lessons and all the other ones we've done. So that's found at tradewestforex.com/blog. And then also the Informer tool, like I say, soon we'll have market depth on this tool. You can find that and download it for free at tradewestforex.com/informer. I've posted both those links for you. I know that there's some questions already coming in on this, so let's go ahead and do that now.